Welcome back to VW Exchange, episode 19, one away from the Magic 20. And we are back live, Brown University. Happy to be here.
Happy to be here too, Adam. You guys, we could just jump right into our big story. Most notable event of the week was the Fed, as expected, cut rates by 25 basis points. Not that 50 basis point number that some were thinking about, but nevertheless, it is a rate cut, and they also penciled in 2 more rate cuts for the rest of the year, so at each of the next 2 meetings.
Yeah, I think that the market seems to be somewhat on board with that. When I was looking at the speech, and it seemed like that Powell was maintaining a lot of directionality in terms of which way that he was going to go, and that he didn't seem to think that the policy rate, while it is still in a restrictive place, that's going to be the direction that he continues to go. So it left a lot in the air, and the market reaction coming off the back of it. I mean, normally the common logic would be, oh, the Fed cuts rates, so rates go down. But the 10-year Treasury bounced up, which isn't like too uncommon. Like when we saw, I think you remember that Friday in August where like everybody started to be thrilled and like all the rates went down and all the stocks went up. I think that's when you saw a lot of the movement. And then here it was really, you're kind of thinking about the forward guidance as opposed to the actual event. So something to note.
Yeah, yes. It was almost like it was priced in, but I kind of wanted to take a moment, kind of just go on an aside, just explaining how rate cuts actually work. So to your point, a rate cut is essentially cutting the federal funds rate, and that's the short-term borrowing rate that banks use to lend reserves to one another. They have to have a certain amount of reserves. So it lowers that rate, and in turn, it lowers other short-term similar rates, commercial paper, CDs, treasury bills, as banks seek those short-term borrowing units instead because they have a higher yield. But then as they go there, increases the demand there, increases prices, lowers yields, kind of just creates a new baseline in the economy. And this is why a lot of times we talk about how bonds, treasuries are like the fundamental staple to always look back on when weighing other investment decisions. So it sort of creates like a reset, a baseline, and then longer term yields can move with it. But something weird, not something too weird, but they are a little bit elevated, and sometimes there are concerns with the yield curve. If inflation's not in the right place, investors want a higher return for that. So it's all things to consider, but typically rate cut signals to investors that Fed funds rate is going to be lower for a longer period of time. Inflation is usually in a lower place. It's moderate right now, but for the most part, things act in unison with that.
Right. And no, that's super helpful. And I think think about the bond mark too when we think about it as the basis of things, that the federal fund rate is the basis of all those other bonds that we look at. So that's helpful just to know the bedrock of it. And I kind of had like some moderate concerns about the inflation side of the mandate, and also just a broader frustration about why we even have a dual mandate in the first place, of why it can't just be inflation. Because, and I think that we'll get to this when we get to MMT, but I think like one of the important insights there is that like we can't pin down what is the natural rate of unemployment. Like we can take a good guess, but it really depends on all these structural factors and like all this efficiency that we're looking for in the economy. And like when you see an unemployment rate that is, I think, 4.3%, which doesn't like jump off the page at all to me, and you're looking at PCE, which is still 2.7. Powell says that it's going to be 2.1 in 2027 based on how the market's pricing it. And to me, that feels too long. I mean, it didn't seem like that anybody cares, and maybe nobody does, which is like fine. But that still seems like way too long to stay above your target if that's going to be your target, especially when. But I mean, you can't deny that the labor data is looking softer. So I don't know, some thoughts.
Yeah, I agreed, and I think the labor revisions really spooked some people because, even Powell came out and said it. If he knew that labor numbers were this bad, he would have already cut rates. So, just another thing to kind of consider. But of course, following that rate cutting pattern.
Right. And maybe we can take it to this next story about TikTok. You threw this on there, so I'll let you do the intro.
Yeah. So President Trump and
Xi
President
Jinping.
I always get confused. Xi Jinping had a productive call apparently today. They're going to meet at the Asia Pacific Economic Conference in South Korea later this fall. Trump's even talked about making a trip to China. President Xi coming to the U.S. Basically they're in the works on this TikTok deal. A little rundown of what the structure is going to look like. Right now, majority owner is ByteDance, Chinese-based company. But given this new deal that's about to go through, new investors and existing backers are going to own around 80% of the company, and ByteDance's stake is going to fall to around 20%. So that's kind of a little overview of what we got right now.
Got it. And what kind of jumped out to me, and I don't even know that it's like that big of a story, because I think that this is kind of how the executive is operating now, but that we have like a lot of Trump's friends and donors. I know that like just about everybody is a donor to both political sides nowadays, so that probably doesn't mean that much, but that Oracle's heavily involved in this deal. Susquehanna, who's also a donor to Trump, their CEO, Chief Executive General Atlantic, also a Trump donor. So I think that keeping that in mind, I wouldn't call this like necessarily corruption, but I think that there is an element of people trying to stay on Trump's good side. And this is just an aside, but we heard the Intel and NVIDIA deal today that NVIDIA is putting $5 billion into Intel. And that $5 billion is like nothing to NVIDIA, who's sitting at a multi-trillion market cap. But I think really more than wanting anything that Intel has to offer, it is probably just $5 billion to please Trump. Now all of a sudden the government stake that they took is worth 30% more. And Trump could post on his Twitter that he saved the day. So I think that is kind of how a lot of businesses are knowing that they have to operate and then kind of, I don't know, hang tight to what Trump wants.
Yeah, great point. And even internationally, I think something else you look at with this deal is that there's still a massive tariff that the U.S. has placed on China. I believe it's around 50%. So China wants something out of this too. They want to work with Trump. And Trump also wants to crack down on, fentanyl coming out of China. So that's something else to consider. But
one more point.
Yeah.
Is there any do you read any of this stuff, like the fentanyl crackdown and TikTok is a massive security risk, all the while we have a billions of people in China who use Instagram and all U.S. technologies. Is this I don't know, is this a cover for something else, or do you think that these claims that the U.S. makes are fully legitimate? Open question.
I have no idea. I mean, what is China gonna do with a video of a bunch of kids making stupid TikToks? I don't really know. Or dancing in front of a camera. I don't know, but it is apparently a concern of national security, and
and it seems to be bipartisan support, right? These aren't, I don't think anybody really questions so much that China is the enemy. And I think that we see this in the Democrats and Republicans are kind of hesitant with the NVIDIA deal to sell chips to China. We've seen Chinese provider Huawei trying to get in on 5G in the U.S. and the U.S. banned that. So different policies are coming up of trying to decouple the American tech infrastructure and Chinese tech infrastructure, which I think is interesting. And even tariffs, really trying to separate out these economies. And I mean, this is super cynical of me, but I would say that this is pre-war proceedings where you have one economy that's trying to make sure that it's not relying on the other's doing the same thing, so that when they start to butt heads more directly, that it's not that they're relying on one another for trade. And I don't know. This has been like a slow build, and we hope something like this never happens. But it feels like that they're moving in that direction with some of like the economic policy.
I mean, that's 100% what it seems like. And that seems like a real goal from the Trump administration since they've come in to make America more self-supportive and less dependent on China for all of its goods. We even talked about that in class, how basically United States, gets a lot of Chinese goods and only charges themselves, just kind of creates money, which we'll talk about later. But, this is kind of the theme from this next story too. Government-backed manufacturing boost. So, the U.S. is going to use a $550 billion investment, actually from Japan when they were negotiating trades and tariffs. So, maybe a win on the tariff side. But basically, this is going to American manufacturing, which has really been struggling. I think it's down 38,000 jobs year to date. And that's with the overall economy adding jobs. So There's been some struggles there. And as we were saying, Trump wants to bring manufacturing back to the United States. And this is clearly represented here.
Yeah, and I thought this was a great piece from the Wall Street Journal. I remember pulling this of what they are specifically targeting, and it was semiconductors, pharmaceuticals, critical minerals, energy, quantum computing, industries where the U.S. has strategic vulnerabilities. Even that language there again, strategic vulnerabilities, that feels like, China might be advancing in these areas, or we might be relying on critical minerals from China. We've discussed that before, and trying to find ways to produce that ourselves. And I think that, having a partnership with the Japanese, maybe that is a feature, maybe that is a bug, that you're sharing some of the risk on one end and maybe developing and deepening your ties and trade relationships, especially with someone like in Southeast Asia. Maybe that is part of this too. But I think what also could be, I don't know, maybe a risk here is that if there's a new administration, all of a sudden, like your ties with Japan and on this big infrastructure arm, maybe that like completely falls away. So that would be one concern, but I think that this overall seems positive.
Yeah, I think at the bare minimum, this is gonna bring at least some level of manufacturing back to the United States. So, say there's another event like COVID and there's supply chain disruptions, the United States will have its own resources to be able to rely and take some of the burden off imports. And just something else I wanted to throw in with this Japan deal. So the costs of the project, manufacturing, are going to be split 50-50 between the U.S. and Japan, but the U.S. is going to take 90% of the profits.
I don't know how that's possible. I don't know what Japan signed up for. I mean, what this sounds like is like a loan, that like here's a loan and like we'll take like a low interest rate on it, but you guys can have the profits, but you guys better pay us back. So I mean, I have no idea how much clarity that they have there, but if it's true, it's awesome.
Seems like a pretty good deal for the States.
No doubt.
As we're talking about this, a big picture we've been seeing in our podcast week to week is kind of, a little bit of a push towards different sides of the political spectrum. And sometimes it seems like it's going further and further each way. And we have a couple of graphs here that maybe you can introduce, Adam.
Yeah, so this was a poll, I think it came out maybe a week or two ago from Gallup on everybody's view of capitalism now. So it kind of started when they started polling around 2010, that 61% of Americans had a positive view of capitalism. Now there's 54% in 2025. So the drop off from 2021 to now is somewhat stark, about 6 percentage points. So that would be worth noting. And I think also interesting is that their perception of a big business has gone down pretty significantly, from around 60% in 2012 to 37% today. And this, varies around party lines. Interestingly, and expectedly too, that support for small businesses is 95% in this survey, free enterprise 81%. So those are still values that people on the left and right share. But big businesses starting to come more under fire. Capitalism similarly. And when we're looking at this Trump situation, this is a different brand of capitalism. So maybe people are more in favor, less in favor of this. But I think that this really stems from probably wealth inequality more so, and also something that I want to touch on that we'll get back to when we get to this Amazon story at the very end of big business. But I thought that was interesting. If you have any thoughts.
Yeah. Just speaking about the Trump administration, it seems like there's been a real, using the state's power to its fullest potential. There was a clip with Obama even recently. We were just talking about this, but he said, people would have called me insane if I did half the things that Trump was doing today. It's just kind of, as you were saying, a different form of capitalism, and big business is not looking very attractive as well. And we'll bring that up later in our Amazon story. But, moral of the story, a lot of a different usage of the state's power that we haven't seen in some time.
Right. And we'll circle back to a lot of the themes in there later in this episode, but we've been taking this class, and this is directly from the Brown University classroom, about a theory pioneered by Stephanie Kelton, among others, Warren Mosler, called modern monetary theory. And I can introduce some of the key tenets here. So part of the idea here is that government deficits government debt is not the same thing as household debt. That governments, they can finance a lot of their expenditures, and they can put it into bonds. And because of their currency issuers, that they issue their own currency, they can finance some of these debts through, printing money through their monetary supply. But also that the real risk here is just inflation as a drag on the economy, not necessarily the amount of debt that you hold, because you can always maintain your market rate of interest according to MMT. And this was a groundbreaking theory for us in the. We try and focus on a lot of things macro, and this would certainly, if all these tenets were true, this would certainly change a lot of things that we view about MMT. But so we're going to try and unpack it a little bit and see if we can't find some places where we disagree.
Sure. Yeah. So, basically, if you're a state, and as long as you're taking out debt in your own nation's currency, then there is no upper limit on how much you can actually take out and borrow. So, in theory, this could fund a lot of pretty awesome programs, free healthcare, free education. In theory, this sounds phenomenal, and we were looking a lot at Kelton's side, who supports this theory. But this other article we had from National Affairs kind of took a different approach, kind of talking about, a few case studies of some nations who have pushed the debt a little bit too far. He brought up Brazil in the 90s, massive hyperinflation, Venezuela in the late 90s as well.
I saw early 20th century, yeah. Austria, Hungary, Poland, Weimar Germany.
Exactly.
There are a bunch of examples.
Yeah. I had a crazy example here. Zimbabwe in the late 90s, 79 billion % inflation when they were trying to adopt too many government spending initiatives. Actually had to substitute their entire currency with the US dollar, known as dollarization. But yeah, this is, two different sides of the coin, and maybe I'd like to, maybe if you want to bring up maybe an example of MMT or why it hasn't been implemented into the U.S. yet, maybe that could be helpful.
I think one thing that I fundamentally disagree with here that I tried to pick out, and this is from MMT's quote and talking about what we did to keep interest rates in check during World War II. Even as deficits exploded and the national debt climbed from $79 billion to $260 billion by the time the war ended, the federal government paid just 2.5% interest on long-term bonds. How is that possible, you may ask? To hold a 2.5% interest rate, the Fed simply had to buy large quantities of U.S. Treasuries. It required an open-ended commitment on the part of the Fed, but it was an easy commitment to fulfill. What that says to me, and what I don't think people get about like the shady monetary policy trade-off, is that when the Fed does what we call quantitative easing and goes out and buys select amounts of long-term treasuries, of mortgage-backed securities, of toxic assets, whatever it is, that those things hang around on the Fed's balance sheet. And that's why I threw up this graph. And I know that it's like a little bit opaque, but I'll throw it up on the screen on the podcast too. But you'll see, even when we had like the liquidity surge during COVID and we started buying a lot of assets, that you'll see this spike in like year-over-year inflation afterwards. And there's like a bit of a monetary lag, which we didn't get to see in class. We just saw the Fed's balance sheet goes up. Nothing happened to inflation. Look, we should just print money all the time. But there is a lag, and I think that that's something that people need to be aware of, that you can't really control your market rate of interest, that is going to be ultimately determined by investors. And you can determine in the short term if you want to go out and buy a ton of treasuries and try and control the long end of the curve, but you can't do that indefinitely because inflation is going to force investors to demand higher yields or they're going to run away. And I think that there's an element of like cockiness in this essay that, it happened in these third world countries, but we're the U.S., so, we have a lot more slack. We have a lot more credibility. But the way you get that slack and credibility is by not doing this, I think, long term. So I think that those are some of the negatives I pointed out, but I think that there are probably some positives too if there's anything else you want to discuss here.
I mean, I can go back to positives, but I kind of just wanted to jump to this one part, just talking about reducing debts the right way or the only ways that are, some theories on it. So a few of the article outlined were, one, reducing your fiscal deficit, something that the United States is not very good at. So instantly kind of ruled that one out. Another one was central banks printing more money and then monetizing that debt. That's what MMT enthusiasts believe in, as you were saying, in those countries through those studies we saw, of course, failed. And the other one was this economist named Blanchard, president of the AEA, post-war period, basically said that, we took out a lot of debt to finance the Second World War, and our GDP ended up outpacing interest rates from the debt that we took out. These are all real numbers adjusted for inflation, still outpacing it. So this is another theory to kind of work yourself out of debts. It'll be, increasing your GDP as a country, increasing your productive capabilities. But this only works when you have a lower debt to GDP ratio overall. And that was kind of something very interesting that I found. A lot of even the Trump administration talks a lot about eliminating the national debt through higher economic growth, and that's why he's so adamant on lowering interest rates, because that sparks economic growth. But given our fiscal debt in the first place and its ratio to GDP, might just be a little bit too high. So that's something I noticed from here and wanted to preface.
No, I think that is a great footnote. And I think what we see, especially when, like, why, for the MMTers, like, they would look at it and say, like, why does it get out of hand when your debt to GDP ratio gets too high? Why do you even need the growth part of this equation? But in reality, if you're not growing faster than the interest rate that you're paying, especially as that debt pool starts to get bigger, as it gets bigger, there's bigger supply out there and less demand, so the yields on those are going to go up. And it can really cycle on you badly if you're not growing at a requisite pace. So instead of just dumping money into projects that aren't going to get the return that you need as the U.S., focusing on ones where that this is worth borrowing for. This isn't just like burning cash to burn cash. But I think that there is a good insight here with MMT in that trying to maximize the amount of debt that you can have isn't necessarily a terrible idea as long as it's sustainable, because as those projects are in here, it remains accessible to the public. Like, the public can use a lot of these goods. And especially like when the economy is going bad, like when you're having a 2008 moment or when you're having a COVID moment, knowing that you have some slack to spend and print money for a brief period of time when you know that you're going to have no inflation or deflation in the economy, that you have slack to spend, that's a valuable insight as well. Because like during COVID and during 2008, that's not the time to say, okay, now we have to cut spending because the government has to keep it in check. I think that having those levers move almost oppositely, that's something that I think is just a helpful framework, and possibly the right path, though. These things are more complicated than we can imagine.
Yeah. And just really quickly, I wanted to speak onto your point before. I know you mentioned investing in the right things is incredibly important, not just burning cash. And not just burning cash for the sake of doing it. What did I write here? Oh, yes, of course. So kind of like supporting the cause of MMT. Inflation kind of becomes that roadblock.
Mm-hmm.
But overall, we could sponsor a lot more programs, and you do need that government intervention, especially in those downturns, as you were saying, because a public deficit is a private sector surplus, and that's kind of the big point. If the government's running a deficit, you could just kind of change the wording there and say that this is a private surplus. If you said, instead of $30 trillion deficit, you said $30 trillion private sector savings, that would sound a whole lot better. So that's another perspective there, and maybe if we could continue running a debt but keeping it at a constrained level, spending it on the right things, I think this is how you get MMT to be feasible.
Agreed. And we'll come back to this again. I'm sure that like these, when we get to critical moments, that these advocates are going to come out of the woodwork and the conservatives are going to come out of the woodwork. So we'll revisit then. But this, we had a story called "The Less Efficient Market Hypothesis" by Clint Asness, who is a hedge fund manager. This is coming from someone in the markets, which I thought was interesting. And the idea was basically that markets have gotten less rational over time, that we've seen the spread between value stocks based on looking at book to price, cash flow to price, trailing earnings to price, forecast earnings to price, that looking at those metrics, that the standard deviation away from what is normal has increased a lot from the 80s to about 3 standard deviations over what's considered normal today. And that's been steadily increasing over time. And he has some thoughts about why this might have been taking place. He says that index might be one of the causes, low interest rates for an extended period of time might be one of the causes. And then lastly, having social media and cheap trading costs, and that possibly being one of the causes why markets could be less efficient today than they used to be in the 80s, which, especially given all the data we have, seems very, very hard to believe, but I thought was interesting enough to entertain and pass it to James.
Yeah, I mean, this totally goes against everything you hear. You think technology is great for the markets. It's democratizing things, of course, and getting everyone sort of on a similar playing field and being able to invest in the world's biggest companies. But I think he brings up a lot of valid points, especially with that third mention of explaining basically that tech is bringing us backwards in the investing world. Basically saying that everyone thinks that they know enough. They know everything. Cheap and easy trading, make people overconfident. There's an abundance of information coming in, and everyone thinks that they're Bill Ackman or Warren Buffett. There's also kind of a trend that we've talked about before. This is like social media encouraging this hoarding of behavior, everyone going in at the same time. There's no real fundamentals behind it. He also talked about trading addiction. Some people are just becoming so hooked to, pouring their money in. And technology, as you were saying, just amplifying all the noise around topics and stories, and people over-investing and becoming overly confident without the fundamentals actually being there, which is what investing should be about at its core.
Right. I thought that this was a good story, and I really wanted to bring up this one line that I thought was pretty great about indexing. And then I will get to the social media point because I think that's kind of the heart of this piece. But he writes, When finance PhD students are in their cups late at night, there's a frequently discussed cone. What if everyone invested only in the capitalization weighted index? No one has a great answer to this. It's kind of like the finance equivalent of a singularity. How can prices be set if nobody is actually looking at anything? So this is very interesting because when you think about the amount of people who are indexing in the S&P 500 and are just trusting the markets, there is those people, and then there are the selective stock pickers. And I think the proportion of the people indexing has gotten a lot greater. The percentage of stock pickers has gone down with all the people indexing. But the real risk here, yes, there are the people indexing, and they're all relying on the judgment of those stock pickers. So tying that into your social media piece, if we have a lot of idiots who are stock picking, then that's not going to be good for the market because it means that I'm going to end up exposed to them, which is bad. But then on the other side, I mean, hopefully we still have a lot of opportunities out there for hedge funds and stuff to be able to profit and short and use derivatives to make money off of some of the inefficiencies that retail traders are doing. But there is kind of that there's a mention in this piece that the bubbles or the mispricings, they can last for longer, especially because everybody's in these indexes, and any move that retail traders are making, once you get exposure to that in the index, that just amplifies all those moves. So you have to, if you're wrong for longer, and if you're right for longer. And it makes it really hard for some of these managers, especially if you're reporting quarterly or monthly and you say, under the S&P 500 again, under it again, that there's only so much patience people have. So it makes it really hard to, do your job and manage risk properly when the S&P 500 just rolls right over you.
Yeah, I mean, it might only be semi-annually reporting coming up. We didn't mention too much of that, but yeah, adding on to your point, if you're in the tough time for a long period of time, basically this was his point. It's only going to be magnified, and it seems like, according to some of these graphs, we are massively overpricing these stocks. I found one, it was kind of like the difference between the most expensive and the least expensive stocks, and it was like he called it the value spread. And, similar to the other graphs, spiked during the dot-com bubble. It's at an even higher level as of recent. Maybe it's come down a little bit, but nevertheless, very expensive stocks, something that we will keep track of.
Agreed. But thinking about where the growth has been in the U.S. stock market too, you would have been a big winner if you were in some of these tech companies. So it's such a frustrating puzzle for some of these people who are trying to pick the right places for risk-adjusted returns. But also James's point, I think something that hasn't been going on for the entirety of the tech run is that we have a lot of random stuff happening. That we have Wall Street bets and GameStop. We have S&P 500 memes that roll around everywhere. We have the SPAC boom. We have all these different areas of Bitcoin, which might have intrinsic value or not. We have GoPro, we have Opendoor, we have Kohl's, Krispy Kreme, all these companies that randomly go up and down based on what people on Wall Street bets think. And it just seems like a very frustrating puzzle and an interesting puzzle for why some of these stocks go up, especially when it seems like there's absolutely no quantitative analysis that you can do to figure out which ones are going to move.
I mean, yeah, it's like the hoarding thing that we were talking about before. I mean, basically the structure of stocks, it's supply and demand. If more people are buying stock than selling it, stock's going to go up. Doesn't necessarily matter what the fundamentals are behind it. Maybe we'll just be a generation that doesn't really care about numbers, and it'll just keep going up forever in our fairy world, and everyone will be rich. Or one day it's gonna earnings aren't gonna be there. People are gonna get nervous,
be poor.
and valuations are gonna come crashing down. But hopefully that day does not come.
And one more side note here, because we talked about the private equity thing, that this piece also mentioned that a lot of people are going into private equity to hide, and that used to be the hiding place to get around some of this liquidity and volatility, and the private equity people can always say that their fund holdings are, they're right at this net asset value because you don't have to mark to market to what the S&P 500 is at. But that has become a lot more crowded, and the returns have gotten a lot more compressed. So this person doesn't see that as the right strategy going forward. But I think that was worth managing quick before we move into our last story. And I can also kick this one off quick. This was if you remember Lina Khan, who used to be the head of the FTC, which is the government body that really regulates mergers and acquisitions, among other things, to watch out for antitrust. And she wrote this piece on Amazon, and this was about 7 years ago. So she was in her late 20s and was somehow the head of the FTC, which is a remarkable accomplishment. But the idea here is that the old framework for antitrust was around consumer welfare. So that is cheap prices and as big as output as possible. How cheap can you make stuff for consumers? And this is really a short-term lens. And what Lina Khan is saying, that focusing just on that doesn't work anymore because you can have possible monopolists or someone who is pricing their products in order to undercut the market and really grow their scale and grow how integrated their technologies are going to be. So at some point they have this efficient economies of scale, and you have capital markets that are willing to sit through 10 years of losses, hoping that there's going to be an outsized gain at the end. And what this means in terms of how we should approach it from an antitrust perspective, because consumer welfare is maximized when Amazon is losing $10 billion a year to fund cheap products for everybody. And at some point, in theory, maybe those prices rise, or maybe you've distributed the cost so much that Amazon can finally start making a lot of money, which they are today. We do live in that era, but we were buying everything on Amazon 10 years ago when they were losing money on it. So I thought that this was an interesting framework to see where this goes, because there's so many people who are thinking that way for the long term and trying to build a platform that is like all encompassing. And really a market maker of Amazon between buyers and sellers, and people trying to create similar ecosystems. And how antitrust is going to think about that going forward is an important question.
Absolutely. Yeah, it's a really very strong rundown. I mean, we're buying from Amazon 10 years ago. We're going to be buying from them 10 years from now. But basically the point was, she noted how Amazon was making these meager profits. They expanded completely. I mean, you see it today. If you want something overnight in the next couple of days, you're going to Amazon, of course. So kind of just, as you were saying, this whole theory of consumer welfare just doesn't work. It only, it's too late to the game. And, it basically her future recommendation, how she hoped it could go, it'll react before the company actually gains dominance and not preventing them like at a later stage. So it becomes kind of a weird game. And it's like, how do you restrict a growing company in the early stages, especially today when you have, all these different rounds of funding? You look at a small startup, they can get VC funding and all these different seed rounds, and the investors don't even care that they're not making money. I'm pretty sure Uber is still not even a profitable company, or might have only just very recently become profitable.
That's a great example.
Yeah, I mean, now it has the entire market, and that's where we're at. I mean, maybe you could say Lyft is there, but that's, that's how it goes.
I brought up this question when I think we were talking about Walmart or some other company not too long ago, but do you think that there is a real risk that once someone like Amazon has sufficient scale and they are the go-to player, or when Uber has completely swallowed Lyft and doesn't have to lower their prices to match them anymore, or when Instagram they've copied Snapchat, they have the Reels from TikTok, and they're the go-to social media platform, that all of a sudden they can impact their business model, and then you see the disadvantage to consumer welfare. Is that a risk here, or are we, the consumer, always going to be the beneficiary of these massive companies?
That's a really good point. I think I always go back to, the railroad examples, and that's where the Sherman Antitrust Act, of course, came from, and, building from there. But I think in today's market, I'm really trying to think of examples, and I don't know if I could actually come up with one at the moment. Maybe this is what the FTC does once they do have that market reach. They are, ensuring that they don't go off the walls, but that also creates a problem because there's only one player in the market. So wouldn't you rather have a few different car companies that could drive prices maybe even lower and offer differentiated services? That's another big driver of course, capitalism. So I think maybe I'm not seeing the price impact, at least not that I can think of off the top of my head, but maybe we are losing some diversification and differentiated units.
Definitely. And it's such a tricky question for me too, because at one point, like, you have investors who have been with Amazon for, with them losing money for years and years and years. And then you tell them, like, okay, now that you guys have the finished product, like, this can't exist. We're breaking it up. No, thank you. That feels like a very tough way to run a system, especially when you have long-term projects that need a lot of time, a lot of infrastructure in order to get the scale that's necessary. Like, all these Amazon warehouses and the shipping process, like, that didn't happen overnight. But on the other hand, there's so many negative consequences, I think, of this. And just thinking about Amazon, they are the go-to player for your product. So if I'm a supplier, I have to take Amazon's price. Like, there's nowhere else I can sell this thing. And if I'm an Amazon worker, it's not like, oh, I can work at Amazon and now I can pivot over to eBay. It's not the same thing. So they're kind of at a disadvantage on having to take whatever price Amazon gets, possibly. But there's also unionization. There are ways to combat that. And maybe another risk here, when we talk about the banks, it's almost a bigger risk, I think, because when we've seen things like 2008 happen, but there is some too big to fail instability, I think, with having a company that is just so big. And we talk about their role in the data space and server space, that every company needs to pass through them somehow. If you're a supplier, you need them to sell your products. You need their data on your reviews. You need to buy their ads in order to be the first thing that comes up when you buy the Amazon product, because they're the ones determining demand effectively with their search results, similar to Google. So such a tricky question, and I pity whoever has to solve it.
And just another point that you were making that made me think of something. Maybe these companies are so prevalent that we don't even realize what prices could be. Maybe we don't even realize if there was more competition, what it could be at. But then again, like you were saying, the amount of effort that goes into creating that scale, and, the winners win, and Amazon does it better than anyone that we've ever seen. Maybe, there could be some other competitors who could come into the market at some point, but it does seem like they're still trying to be competitive. I know they're trying to add drone services and continuing to just speed up, and they're getting involved in different areas of business. Of course, you have Amazon Prime and Amazon Web Services. Mm-hmm. So I do think they're still being moderately competitive, but maybe we're getting ripped off along the way. I don't know. I'm not going to sit up here and defend Amazon with my life, but I think that, from what I understand, it seems like they're doing some good for the world. I like having clothes the next day, but
I haven't paid a shipping cost in 5 years. Exactly. Like, it is absolutely bananas. And I think that winner takes all approach in creating something that is such a large scale, it is super important that they keep innovating, because one of my thoughts was, okay, now that you have this product, especially something like Amazon, something like Uber, it's something that it works a lot better if there's only one, right? The delivery network's so much more efficient. The data is so much more efficient. Even something like Uber, if every Uber driver, if Uber and Lyft were to merge and everybody was on the same platform, that there would be efficiencies from that. That some things might just be better with one, as long as they are always experimenting. So I think that is a key, because the government could go in and nationalize Amazon and you would still get your packages, but there would be no drone innovation. There would be nothing new happening. Just packages would still come, hopefully, and probably a lot of other stuff would start going wrong. But I thought that it does seem like a tricky puzzle.
Absolutely, yeah. I mean, I'm sure more firms, if you attacked that issue earlier on in the cycle, would be helpful. But again, I just don't know how it would play out. But I think it's a good rundown of what we got.
Yeah, that was a full episode. Thank you all for sticking with us. I'm happy to touch on some of the current news, and then I always like to throw in the theoretical jargon at the end. So hope you enjoyed.
Thanks for sticking with us. Take care, guys.
Bye.